This is the Asia Trade. I'm Shery in Tokyo. The top stories this hour. Asian stocks open under pressure on signs of weakness in the U.S. economy and worries a trade war will reignite inflation. A lack of specifics on President Trump's Wednesday tariff barrage keeping traders on edge. The president also declaring displeasure with Russia's Vladimir Putin over Ukraine, threatening secondary tariffs on Russian oil. Plus, China set to inject almost $70 billion into 4 state banks through share placements to beef up their capital buffers. We'll start you off with breaking news out of South Korea, though. We're seeing industrial production numbers coming in right now, and we're seeing a gain of 7% year on year. The estimate was for a gain of about 3.5%, so this is beating economists' expectations. The industrial output data also rising 1% on a month-on-month basis. This is also surpassing expectations. Of course, we had seen a little bit of a pickup in business confidence across South Korea, a little bit of that sentiment showing signs of recovery from, of course, political instability and uncertainty around what happens with the Constitutional Court and the president impeachment that is expected any time now. But at the same time, of course, we are expecting more data across Asia this week, including from Japan. Industrial production data from Japan expected to come out later this hour as well. We're seeing now, take a look at the markets because the Japanese yen has strengthened a little bit. We continue to see those safe haven moves with this uncertainty over the economy, tariffs as well coming from the U.S. So right now we're seeing Nikkei futures to the downside of 0.6% and the Japanese yen below that 150 level against the U.S. dollar. We'll be watching the offshore yuan. We have seen Chinese stocks surging over the past 6 months. Of course, we are expecting more reaction to the finance ministry injecting billions of dollars into those state banks. A lot to do this week also with what's happening when it comes to the U.S. jobs report and the U.S. economy. That will give us a better picture. Take a look at how U.S. futures are trading because stocks fell on Friday when it comes to the S&P 500 with, in fact, seeing $5 trillion of U.S. Equity market valuations evaporating since late February. A lot to do with worries about the U.S. economy. We saw a plunge in U.S. consumer sentiment, a surge in long-term inflation expectations. So a lot of that haven moving into Treasury. So we continue to see that advance. Gold also hitting a record high, but it's about oil. Take a look at Brent coming online up 0.3% as we're really setting up for that barrage of tariff news, whether it's reciprocal tariffs coming into place on April 2nd on trading partners or perhaps on Russian oil, according to threats by President Trump. He signaled that he's unhappy with Russian President Vladimir Putin and would consider secondary tariffs on Russian oil if a ceasefire with Ukraine can't be reached. Trump also told NBC News he plans to speak with Putin this week. Let's bring in Bloomberg economy editor Michael Heath here. And Mike, I mean, we have seen this relationship and this friendship between President Trump and President Putin. But what's happening now?
Hi, Shery. Yes, it's a really interesting situation because this seems to be the first publicly critical remarks that President Trump has made about Russian President Vladimir Putin since Trump sort of returned to power. And as you mentioned, there's always been quite a warm relationship, or particularly on Trump's part, towards Putin, almost a fascination with him. But what this sort of suggests is that Trump is cottoning on to this notion that Russia is not... It's not really up for a fast deal, or perhaps even it's not really up for peace unless it can get exactly what it wants. And it's deeply frustrating for President Trump, who obviously during the campaign said that he wanted peace done in a day, and now they're talking about April 20. Excuse me. But I mean, what Putin sort of suggested is that President Zelensky of Ukraine is illegitimate because under martial law, Ukraine can't hold elections, and his term ran out late last year, and that there should be a UN-administered government of Ukraine, which basically delegitimises the current government of Ukraine. And it's really upset President Trump, and I think perhaps provide a little bit of clarity about Russia's sort of wider motives here.
In terms of sanctions against Russia, what do we have in place right now? Because we continue to hear from sources that the Kremlin seems to be pressuring the U.S. for Europe to ease on some of those sanctions.
Yeah, I mean, look, it looks like a real sort of power play here coming from the Kremlin. They seem to be trying to leverage President Trump's frustration with Europe for their own ends. So the main thing is about, well, the point of discussion here is sort of about reconnecting a major Russian bank to the SWIFT system. Now, in 2022, it was disconnected, and it's Europe that actually holds custody of that, and will have to make that ultimate decision. So what Russia is sort of wanting to do is to get the US to agree to it, and the US to then pressure Europe to ease those sanctions somewhat and allow that bank to to rejoin SWIFT. The question is whether this was actually even completely agreed to on the US side, because we know there's been contrasting readouts from these talks between Putin and President Trump. That's happened a couple of times. And Europe seems to be signalling that it's got no intention of easing sanctions. If anything, it's going to ratchet them back up on Russia to try and exert some more pressure on it. So it's going to be really interesting to see how that European-US relationship unfolds. But the Kremlin's looking for the US to sort of do some of the work for it there, it seems.
Yeah, it's been really interesting to actually see that anti-American sentiment rising in Europe and Europeans trying to boycott U.S. products. But it seems when it comes to President Trump and the UK Prime Minister, they seem to be having some fruitful talks when it comes to the economy.
Yeah, the UK PM is, I mean, a little bit like down here in Australia, very old alliance, and trying to sort of maintain that bond with the US and sort of leverage its special relationship to avoid some of these tariffs as well. But very much the UK wants to keep the US involved in Europe. I mean, it understands the weaknesses of Europe militarily and in terms of being able to supply, arms and ammunition and intelligence to Ukraine. So it wants to keep the US on board. And the US is just such a powerful economy, such a powerful military and player that, the UK would sort of be devastated, I think, if the US pulled back from it. So it's trying to use this traditional partnership dating back to World War II. And look, the rhetoric seems to be very positive coming out from that. But again, until we see, what's unveiled this week, what the situation is for the UK for its own economy, and then more broadly, if President Trump does talk to Vladimir Putin, what sort of comes out of that as well. So as I always seem to be saying, we'll just have to see how it unfolds. But very, very interesting situation.
What role is Asia playing in all of this? We know that Secretary Hegseth, for example, made his way through Asia-Pacific just in the past week. Yeah, well, I mean,
the interesting part, just going back to President Trump, is that he's sort of raised this issue of secondary tariffs, which is sort of an unusual idea. But the point seems to be that Russia has been able to sell a lot of its oil to China, to Asia, and President Trump is sort of talking about closing that down. If Russia is going to delay, peace talks, if it's talking about having to set up a new Ukrainian government, which President Trump sort of rightly perceived as meaning that it would take a long time to get to any sort of peace agreement or talks, then he's considering putting tariffs on these oil sales, which go to the cheap oil that goes to India, that goes to China, and has supported Russia's economy a lot. So it's quite a significant threat there. He wouldn't shut it down, but there'd be a degree of tax presumably levied on that. But if it did close down those routes, that would put a lot of pressure on Russia. So yes, Asia is significant here.
Yeah, Bloomberg economy editor Michael Heath there. And of course, China is a big player when it comes to the Asian economy and geopolitics at large. China's finance ministry now saying that they will inject $69 billion into the country's biggest banks through share placements, following through on Beijing's earlier pledge to beef up capital buffers. So with Chief North Asia correspondent Steve Engel joins us now from Shanghai. Steve, why is this important for authorities?
Well, we knew it was going to happen after the policy measures that we got out of the National People's Congress. We also got signaling from Beijing back in September. Remember, late September, we had that first real big batch of stimulus. We got an indication that the banks needed recapitalization. Even though their capital levels are, above the requirements, they've taken it on the chin, of course, over the last few years of sluggish growth and the property sector meltdown in China. Their net interest margins have have been hurt. Their profitability has been squeezed, and rising non-performing loans. Bad debt has been a problem, especially those tied to a lot of the property problems. Net interest margins at the banking sector in China slipped to 1.52% in 2024, the lowest ever. So they essentially need the recapitalization to provide loans and service the real economy to get the the mojo back, if you will, in the Chinese economy to spur domestic consumption and counter, obviously, those trade protectionist winds coming from the likes of the United States. So in this recapitalization, you mentioned $69 billion into 4 of China's largest state banks via their share placement. So we're talking Bank of Communications, Bank of China, Postal Savings Bank of China, and China Construction Bank. They plan to raise up to a combined 520 billion yuan through additional domestically listed shares. The Ministry of Finance will be the top investor in all of the proposed private placements, and they will basically issue these new shares at a premium between 8.8% and as high as 21.5% above their Friday closing levels in Shanghai.
And see if President Xi Jinping wants to team up with global business leaders in order to push back against protectionism coming from the U.S.
Yeah, that's something that was well telegraphed as well through the China Development Forum that I attended in Beijing last weekend, followed then by the Boao Forum in Hainan, which I was also attending, and now on Friday at the Great Hall of the People, as predicted, some 40 business leaders, including Blackstone's Steve Schwartzman, Judy Marks from Otis, Raj Subramaniam of FedEx, Cristiano Aman of Qualcomm, Ray Dalio of Bridgewater, Albert Bourla of Pfizer, just to name a few, including some car makers like Akio Toyota and the chairmen of Mercedes and BMW among the list of people meeting with Xi Jinping, really turning on the charm offensive against the backdrop of these Trump tariffs. He didn't mention the United States, but he says, I hope you foreign business executives will share your sensible views and take actions to push back against the retrogressive rules and the zero-sum games. He called China a favorite destination of foreign investors and foreign businesses. Embracing China is embracing opportunities, said Xi Jinping in the Great Hall of the People Friday.
Our Chief North Asia correspondent Stephen Engel there joining us from Shanghai. We're watching Australian stocks right now. We're seeing the ASX 200 seeing its worst day in more than 2 weeks at the moment. One stock that we're following is software company WiseTech. They're now saying that they've significantly progressed a detailed succession plan, which will be considered by the board with a further update anticipated to be provided to the market in coming weeks. Right now down about 1%. Coming up on the Asia trade, more navigating Trump's tariffs with Moody's Analytics and JPMorgan Asset Management. Plus, AI in focus with 2 exclusive CEO interviews. CADDi tells us how the technology is reshaping manufacturing, and Wrtn Technologies joins us after closing a $74 million funding round. Much more ahead. This is Bloomberg. Here's a quick look at the major events coming up this week, dominated, of course, by Wednesday's announcement of President Trump's so-called reciprocal tariffs against U.S. trading partners. The president has said the levies will be lenient, but money managers are on guard given the lack of specifics. Meanwhile, U.S. employers probably tempered their hiring in March as trade risks cloud the economic outlook. We get the jobs report on Friday. And here in the Asia-Pacific, Australia's central bank is expected to hold rates on Tuesday. China's PMIs could also show construction picking up this month. For more on what to expect, let's bring in Katrina L., Director of Economic Research at Moody's Analytics. Katrina, always great to have you with us. At what point do the tariffs expected this week become economically significant in the sense that the transmission will actually cause real problems in the real economy?
I think that's a great question, and I think we need to remember that, just that the threats themselves of tariffs that we've been seeing throughout President Trump's term and even before he came back into the White House have been economically significant. We've seen, shifts in sentiment in particular, not just business sentiment throughout the region, but also consumer sentiment take a hit. And we need to remember that when households and businesses are feeling more concerned about the future, that does result in economic outcomes that are negative. And I think when it comes to how we're seeing export performance play out, I think it will probably be a few more months before we see that negative impact. But we certainly saw, in the final months of last year and certainly early this year as well, there was some front loading of shipments. And so we did actually see that temporary boost in consumer goods heading to the US that certainly won't last through this year as those tariffs start to take effect.
Yeah, it's been interesting looking at the industrial production numbers across Asia as well, because we saw a little bit of that front loading happen already when it comes to those exports. Now, the administration in the U.S. is saying that foreigners will eat up most of the costs, that this is like the biggest tax cut for the middle class in America. What can we expect for the U.S. economy? We are getting jobs data this week as well.
Yeah, I think it's an optimistic view to expect that foreigners and foreign manufacturers and foreign consumers ultimately will pick up the tax bill for tariffs, because we know from Trump's first presidency that it doesn't exactly play out that way. What happens is that US producers take that hit, and eventually that does flow through to consumers. And we do know that the jobs market in the US is already slowing. We know that households are already acutely concerned about the inflationary impact of these tariffs. And so what we do expect to see is, the US economy continuing to slow. We should see that with the March employment report coming out on Friday as well. It should be another lukewarm result. And I think all these, haphazard and aggressive policy changes that we've seen from the Trump administration are having negative economic impacts. And that's why we are seeing, the rhetoric around US economic recession odds rising quite aggressively because of all these haphazard changes. And so I think it's a concerning picture that we're going into. And, last year it was this story of how the US economy is resilient through the face of elevated interest rates, but certainly that's not the case this time around in terms of that slowing labor market. And I think that the Fed really has its work cut out for it in terms of trying to manage a slower US economy at the same time as we are seeing tariffs directly threaten this picture that inflation will continue to sustainably remain around the 2% target.
And really not the case when it comes to the resilience of the U.S. dollar, right? Will the dollar stop being a safe haven asset? We haven't really seen it react given the risks right now.
Yeah, I think that's the million-dollar question in terms of where the US dollar is going to go. On the one hand, it is still an attractive haven asset, and also because the Fed is keeping interest rates higher for longer, it does mean that the US dollar is more attractive. But at the end of the day, I don't think we will be moving away from the US and the greenback being that haven status. But it is creating a lot of headaches, in particular for central banks in Asia, because they are trying to navigate hopefully easier monetary policy settings to try and shore up that domestic demand. But with their own currencies coming under pressure, it really does challenge their ability to do that.
Yeah, what are we expecting from the central bank where you are? The Reserve Bank of Australia this week also announcing policy.
Well, for the Reserve Bank of Australia, it is a quiet one, hopefully, which is nice in this kind of economic landscape to get no news. We are expecting that they will keep the cash rate at 4.1%. And, the RBA has made it very clear that they are in wait-and-see mode when it comes to policy making. They've already delivered one 25 basis point cut, but I think we're going to have to wait a little bit longer before we see further rate cuts, because at the end of the day, the RBA is waiting for the outcome for the federal election election in Australia, which is going to be held early May. We do have both sides of politics coming up with some, measured but still encompassing support to households. And so there will be inflationary impacts there. And of course, they are waiting to see how these tariffs play out, not just in terms of Australia being directly impacted by US tariffs, because I don't think that's the big risk, but they are waiting to see perhaps how China is impacted and then how China's economy responds, just because of how close Australia is with China and how reliant they are on Chinese demand.
Yeah, we are expecting March PMIs out of the Chinese economy, but also the fact that the finance ministry is now injecting liquidity into state banks. What does that tell us?
It really tells us that policymakers are really stepping up their support to the economy to really try and insulate it from the ructions and the negative impacts that US tariffs will have on the Chinese economy. And so we are seeing not only support to banks and additional liquidity coming online, but we really have seen this important mindset shift from Beijing to say, okay, we really need to provide more direct support to Chinese households if we are to actually reach our 5% growth target this year. What we've been doing so far just hasn't been enough. And so we have seen, minimum wage increases. We are also seeing promises to increase support to pensioners and medical insurance payments. And it really does tie into this idea that if we improve China's social safety net, then that translates to higher spending from households, and they will start to release their precautionary savings. But importantly, this isn't a trend or something that happens overnight. This does, take time to impact. And so I think we will continue to see China's economy really struggle this year, because domestic demand can pick up a little bit of the slack from weakness in manufacturing and exports, but it can't completely overwhelm that impact. So another challenging year for China, and I think that 5% growth target is a tall ask at this point.
Katrina L., good to have you with us, Director of Economic Research at Moody's Analytics, and really that concern about the broader economy being felt across global bond markets. We saw the Treasury rally now, taking Treasuries up about 2% this quarter already. We continue to see those gains in the Australian and New Zealand bond markets as well. When it comes to the 3-year yield, now at the lowest level since September of 2024, the 10-year yield in Australian government bonds also at the lowest level since mid-January. And now with this outperformance of bonds to stocks, very interesting in this risk-off environment where we're seeing even the dollar falling, not rallying as a safe haven right now. We'll continue to watch Treasuries as well as we see those gains being tracked in the Asian session as well. We have more ahead on the Asia trade. This is Bloomberg. You're watching the Asia Trade. The latest from the corporate front, China's Hong Kong and Macau Affairs Office has reposted an editorial from a local pro-Beijing newspaper urging C.K. Hutchison to stop a planned deal to sell 2 Panama ports. The report says the consequences will be serious otherwise. Bloomberg reported last week that China has told state-owned firms to hold off on any new collaboration with businesses linked to founder Li Ka-shing and his family. Chinese property giant Country Garden has posted a narrower loss for 2024 after a series of steep write-offs on properties both finished and under development. The loss for the year stood at about $4.5 billion, compared with a record $24 billion in 2023. Country Garden is still in restructuring talks more than a year after defaulting on its debt. This is Bloomberg. Take a look at how commodities are trading at the moment. We're watching oil prices. Of course, we saw 3 weeks of gains, a little bit of pressure given the concerns about the broader economy. We're getting some news coming from President Trump speaking at the moment, saying that he's making progress on the Russia and Ukraine talks. When it comes to the oil sanctions potentially against Russia that he's threatened in the past, is now saying that he's not putting them on right now, that he's going to make a decision on those secondary tariffs on Iran, though we have heard those threats before. before if Iran doesn't sign a deal renouncing nuclear weapons. We heard from the Iranian president as well that he won't engage in direct negotiations with the U.S. President Trump saying that the tariffs will start with all countries. We are, of course, expecting those reciprocal tariffs coming into place on April 2nd. Oil prices at the moment gaining 0.2%. Gold already at the highest on record, continuing to gain ground. For more, let's bring in Garfield Reynolds, who leads the Markets Live Asia coverage. Garf, good to have you with us. So what will you be watching as a key catalyst this week? Because, of course, we have the barrage of tariff news, but we also have plenty of economic data to look through.
Yeah, the economic data is going to be pretty key because of the concerns that these tariff policies will especially they will sap US growth, and US being the world's largest economy has a broad influence on global growth as well, and also the potential for them to drive up some prices and drive down others when it comes to commodities in particular. There's also just the sheer uncertainty angle. The pronouncements from the president and his administration seem to change direction on a pretty regular basis as to exactly what's going to happen. But whatever clarity there is leaning towards the idea that there will be a lot of global trade areas affected, that there will be tariffs at the very least threatened. If we remember what went on with Canada and Mexico, where it was a lot of back and forth, and eventually there are some tariffs that have been imposed, and then there are others that are sort of hanging there waiting for various deadlines to pass. So that's a situation where we're looking to see if equities can avoid further sell-off. It does seem somewhat surprisingly that equity investors had still failed to price in the full impact of the tariffs, although, as I said, the uncertainty that Trump has provided perhaps goes some way to explain that. We've also got some pretty strong rallies in bonds going on at the moment.
I mean, I can hear your frustration about the uncertainty. So I guess, as you mentioned, it's really not surprising that we're seeing bonds rallying, we're seeing gold rallying. Interesting, though, that we're not necessarily seeing the reaction in the U.S. dollar.
Well, I mean, we are seeing, in many ways, an appropriate reaction in the US dollar. You could even ask that the reaction in the US dollar is the one clear instance of the markets responding in a way that the US administration has been angling for. Whether you believe there's a serious attempt at some sort of Mar-a-Lago accord that would seek to push the dollar lower against many of its trading partners, the plan with tariffs to revive US manufacturing, push it back towards what it was decades or even centuries earlier, that includes the idea that a strong dollar has been a major headwind for US manufacturing. So the weaker dollar in response to tariffs actually shows the markets accepting the logic that tariffs mean a weaker dollar. The thing that might be a little bit less comfortable for equity investors and perhaps for some parts of the US government is that the channel through which this is happening is that tariffs are seen weakening the US economy.
What a headache when it comes to central bank governors, right? We do get a decision out of the RBA this week.
Yes, we do. Although I think for the RBA in its current setup, for this meeting at least, the tariff headache is going to be a modest one. There were signs when the RBA cut rates last time that they were not as certain about it as the market felt that they should have been. And they were trying to push this as we've made this cut, but don't take this to mean that we're embarking on a sustained cycle of easing. I think the messaging is going to be a bit different this time round, both because of what's gone on with Australia's internal data. We've had a weaker jobs report and a significantly weaker inflation report and some other signs that the Australian economy is definitely starting to roll over. Then when you add in the tariffs and the signals that Australia's economy, while it's not so directly vulnerable to tariffs, it's very vulnerable to the overall impact on global trade and especially to the impact on China. So add all that up and I think you're going to see the RBA be more confident about the idea that rate cuts are coming later this year, even if they will be wary about even signalling that May is going to deliver a cut, because they have to wait for the quarterly inflation data that will drop in late April before they can be truly certain that May is the right venue. But the market is already pricing about a 70% chance they'll cut in May. They're not seen as cutting tomorrow. And then they've fully priced in a rate cut for July. So that situation is going to be sort of similar after tomorrow. Maybe the market leans much more strongly to May, given everything that's been going on.
Right. Garfield Reynolds, who leads the Markets Live Asia coverage with us as we continue to watch those lines when it comes to tariff news. President Trump continuing to speak, saying that he wouldn't want to put secondary tariffs on Russia. He's threatened them, given his frustration with President Putin. He says that when it comes to President Putin, President Trump doesn't think he's going to go back on his word. He hasn't heard anything on limiting tariff action. So we'll continue to watch whether we are expecting those secondary tariffs when it comes to Russian oil if that ceasefire with Ukraine cannot be reached. But President Trump also making a comment when it comes to TikTok, saying that there will be a deal on TikTok. Remember, President Trump signed that executive order extending the ban on the company through April 5th. But take a look at how Asian assets are trading at the moment. We continue to see the downside on Asian Australian stocks, with the Aussie dollar holding at that 63 US cents level. But really it's a 10-year yield, which is now seeing the lowest level since 2024, around the month of September, as we're awaiting that RBA rate decision as well. And this also just days after calling an election. Australian Prime Minister Anthony Albanese's government has nudged into the lead in opinion polls. And Bloomberg's Paul Allen joins us now with more on this. And Paul, Labour had been trailing for months. So what's turned things around?
Well, Shery, it could be any number of factors. It could be fabulous policy and messaging, but the thing that's really changed since the last poll was, as Garfield was mentioning there, the Reserve Bank of Australia cut rates at its last meeting, and that had a meaningful impact for mortgage holders, and an election that's going to be fought around cost of living concerns. That was a big win for the Albanese government. So in the news poll that came out on Sunday, we've got Anthony Albanese back as preferred Prime Minister over the opposition leader Peter Dutton. The Albanese government also ahead 51% to 49% on a two-party preferred basis. Now, in the last survey, which was before the Reserve Bank of Australia cut, those positions have been reversed, and we have the opposition in front, and other polls are reflecting a similar reversal, though. But these polls are really tight. The current majority in government's also very tight at just 2 seats. There's a very large crossbench, and when you boil it down to electorate by electorate level fights, there's a lot of really interesting contests that could decide the outcome of this election, and it's still looking like a minority government's the most likely result post-election, Shery.
The economy is such a critical issue for voters, right? And the economy in Australia, very sensitive to commodity prices. What's the outlook?
Yeah, well, we did get a new set of forecasts just this morning from the Department of Industry, Science and Resources, and it took a look at Australia's major commodities, being coal, iron ore, natural gas as well. It forecasts exports to June this year up 4% on its last forecast 3 months ago to $243 billion US. That might seem a little bit counterintuitive in the current environment, but this is more good news for the government. The bad news, though, is for the rest of the decade, those forecasts start to sink. Iron ore's seen at around about $80 a tonne by 2029, and that's a really important commodity. It's the rule of thumb is every $10 movement in the iron ore price equals about $500 million in additional revenue for the government. So that forecast is seen slipping. Thermal coal prices are forecast to drop. It's just copper that's seen bucking that trend, up about 7% by 2029. And of course, the reason for all of this, it's volatility around trade, the tension there, that's seeing as being a negative for growth.
Paul Allen there joining us from Sydney as we're also headed towards that RBA decision expected to hold on Tuesday. We have more ahead on the Asia trade. This is Bloomberg. We're headed towards the Japanese market opens at the top of the next hour. The Japanese yen has seen some strength in the last couple of days. Of course, we have those safe haven moves given the expectation of more tariffs to come, whether it's on Russia, oil, or, of course, the reciprocal tariffs we're expecting on trading partners from the U.S. on April 2nd. We're seeing Nikkei futures to a downside of more than 2%, so we could see a lot of volatility at the open as we also keep an eye on JGB yields. Global bonds have rallied given the uncertainty and the risk-off sentiment around the world. Here in Japan, our next guest runs CADDi, a data platform for manufacturing companies. The company utilizes artificial intelligence to crunch data to help streamline workflows and optimize supply chains. Their customers include the likes of Tokyo Electron and Hitachi. CADDi just announced new funding of $38 million led by UK-based venture capital firm Atomico. Joining us exclusively now is CADDi co-founder and CEO Yushiro Kato. Good to have you in the studio. Thanks for coming in.
Thank you for having me.
So tell us exactly what your company does.
Yeah, absolutely. CADDi is an AI-powered data platform specifically designed for manufacturing companies. So we transform siloed engineering and supply chain data into a company's valuable asset. What we specifically do is what our product CADDi Drawer automatically aggregates the data from multiple systems that manufacturing companies use currently, and then analyze and extract the data off of the drawings automatically so that people can access, any kind of data without the previous information. And on top of that, our product can automatically recognize the shape of the parts off of the 2D drawings, so that this allows our customers to identify similar parts in the past within the organization. So, for example, for procurement officers, they can identify similar parts in the past and supplier information associated with it. So this, allows them to reduce the cost of parts by identifying better suppliers.
Given all of the tariff news and the risks and the chaos a little bit, we are seeing companies more trying to diversify their supply chains. Does that add to your business performance given the need to sort out these different components?
Yes, absolutely. So, first of all, a lot of companies are, of course, struggling with new tariff situation, and a lot of companies are thinking about relocating their supply chain from the rest of the world to the United States. But oftentimes, they don't have any idea on which suppliers to choose in the United States, even if they have chosen, used some suppliers within the states. So, our company, our product, helps our procurement officers to identify suppliers that they have used in the past within the organization for the similar parts. So that's one, and also this identifies part duplication within their organization. So they can first of all reduce the number of parts by identifying similar parts at the engineering stage, and this helps reduce the cost for the organization because it has a huge impact on the downstream funnel.
How long have you been in operation, and have you seen any changes in the trends? Because I remember during COVID as well, we had these supply chain issues. We, of course, had Trump 1.0, where we had supply chain issues given tariff threats then. I do wonder if some of the narrative from your clients has changed since.
Yeah. So we've been doing this business for 8 years. So we established our company in 2017, and we have experienced a lot of...
at the cusp of the first tariff wars and conflict, yes.
Exactly. We have experienced a lot of changes in the market. So, of course, the difficulty for them is uncertainty, right? So in 2020, the energy price and material price surged a lot. At that time, they of course were focusing on reducing the cost and securing supply chain. So the key is visibility, right? What kind of parts they have sourced from the world, and what kind of suppliers they have used. Which supplier has a capability on which part category, for example. So our product, has given the customers the visibilities across their supply chain, regardless of the data source and supply chain.
When you look at these shifts within the companies and what they ask from you, do you see that trend that we in the news business look at perhaps sourcing outside of China, trying to diversify away from these trade tension flashpoints?
Yeah, absolutely. So a lot of American companies, for example, we have an office in the United States, in Chicago, by the way. But a lot of companies are, of course, trying to decouple from China, but it's very hard. It's easier said than done. So the majority of the customers are seeking a way to find better suppliers within the country or within North America. And again, we have been supporting them to do supply identification.
But you're trying to also expand overseas into more regions. Where do you see the business flourishing? Yeah,
so we have 4 offices in the world, one in Japan, one in the United States, and 2 in Southeast Asia. And we have a growing demand in the United States, again, because of the tariff thing and the uncertainties that American manufacturing companies have been seeing. But it's not only in the U.S., it's also for the rest of the world as well, right? So we are trying to expand in Europe, for example, or the rest of Asia.
Yushiro, Kato, really good to have you with us. He's co-founder and CEO at CADDi. What a great time to have him with us as we talk supply chains during this tariff uncertainty. Catch Japan Ahead every Monday at 8:40 a.m. If you're watching in Tokyo, subscribers can watch live on the terminal using the TV Go function as well. This is Bloomberg. We have breaking news out of Japan. We are getting industrial production numbers. When it comes to the month-on-month data, 2.5% gain for the month of February. These are the preliminary numbers topping economists' expectations and also rebounding from a contraction in the previous month. When it comes to the year-on-year number, though, a little bit of a miss. Gains of 0.3% year-on-year. This was after an expectation of growth of more than 1%. We have seen some front-loading coming from Japan, given, of course, the expected tariffs across the world. We saw robust car manufacturing data that could reflect some front-loaded exports into the U.S. But when it comes to the year-on-year number, it's growth of 0.3%. So month-on-month, we're seeing that number actually beating expectations. We also have retail sales numbers, year-on-year growth of 1.4%, coming in slightly below economists' estimates and also coming in slower growth than the previous month. Month-on-month gains of 0.5%, which is sort of the same pace of growth that we saw in the previous month of January as well. Of course, we're keeping a close eye on retail sales, on consumption in Japan as we are continuing to watch what the BOJ will do next. We do get the Tankan survey of business sentiment on Tuesday as well, so do watch out for that later in the week. Australia's market regulator and the central bank now saying that they've identified serious issues at exchange operator ASX. The RBA and ASIC say the issues are related to trade settlement and require immediate action to resolve. Bloomberg Finance editor Adam Haig joins us now. Adam, what exactly are they saying?
Yeah, so this is a quite significant development, Shery, in the incident that occurred back in December. It was as trading was just kind of closing up for Christmas on Friday, December 20th. And what happened essentially was an outage in part of the settlement system and that the ASX runs. And it took a little while for that to get going again. It wasn't until Monday that it was resolved. So really what the ASIC, the markets regulator, but also the RBA, the central bank, are saying now is that this incident wasn't kind of acknowledged and sorted out and dealt with in a timely enough manner, and they're putting quite a strong position now on expectations that this needs to improve. And of course, this one outage back in December is just one example of many, almost like a litany, a slew of problems that the CHESS, the clearing settlement technology around the ASX has been under scrutiny of regulators now for some time, years really at this point. So this is the latest example, but it feeds into a far bigger issue that the ASX is still undergoing and trying to resolve, and that's that this technology upgrade that's been a lot more costly and a lot more timely in terms of dealing with the upgrade than many people have expected. It's now kind of reached another point. So worth reminding people, of course, that ASIC is already suing the ASX in the federal court for what it says was not an honest update about the progress of the technology upgrade some time ago. So I think really this just refocuses the minds here, and ASX were very clear in the statement. David Clark, the chairman, saying we did need to react with more urgency in this case, and we are indeed trying to get on top of this and doing everything we can to stop this happening again in the future.
Yeah, the ASX losing more than 3% at the moment at one point and seeing its worst day in about 2 weeks. But what sort of remediation actions could we see, and what happens if they don't comply?
Well, I think ultimately, at the end of the statement, it was very clear that both these regulators saying they can do more and they are prepared to do more if ASX doesn't kind of come up with a better solution here. But clearly the ball now is back in the court of ASX, being led by Helen Lofthouse, who's well-versed and has consistently provided this line of they are doing big upgrades to chess. It's well underway. She gave a little bit more detail on the timeline of that today in the ASX's statement in response to ASIC and the RBA. So clearly the ASX feels like they're doing plenty in this region, but the ball's now in their court and they are going to have to do something more substantial here.
Bloomberg's Adam Haig there. As we continue to watch the broader markets as well, the ASX 200 at the moment losing ground. About the worst day in about a couple of weeks or so, when we're seeing Nikkei futures also pointing to the downside. Really not surprising given the global market moves, with Wall Street also falling on the Friday session and this global bond rally continuing. This as we head towards, of course, those reciprocal tariffs coming from the U.S. on April 2nd. Not to mention that President Trump has also threatened potentially secondary tariffs on Russian oil as well. The market opens in Seoul and Tokyo are next. This is Bloomberg. Asia trade, we're counting down to Asia's major market opens as we're seeing some early risk-off sentiment across Asia. Haidi, of course, we are expecting those tariff announcements. President Trump threatening tariffs on Russian oil. Not to mention, of course, we are expecting those details on reciprocal tariffs on April 2nd as well.
Yeah, it's really coming to a head, Shery. There's been sort of weeks of speculation of the narrowing of the scope or potentially the expanding of what we could expect. But those details, the devil will be in those details in terms of how these markets travel next. But it is looking like it is risk-off today.
Yeah, not surprising. We have seen the Japanese yen strengthen in the past couple of sessions and now holding below that 150 against the U.S. dollar level. This as we're getting industrial production output also earlier in the hour. We saw it rising 2.5% month on month, which is beating expectations. But when it comes to the retail sales side of things, rising only about 0.5%, still beating expectations. But really, we are going to continue to watch the consumption side of things for what the Bank of Japan does next. We are now seeing the 10-year yield holding at that 152 level, while we're seeing the Topics and the Nikkei falling more than 1.8%. Do watch out for those automakers, semiconductors as well. Of course, we're going to see details of those reciprocal tariffs coming from the U.S. Very soon. Take a look at how South Korea is also opening, because we also got industrial output numbers and the data rising 7% year on year, which is almost more than half than the expected pace by economists. A lot lot of it perhaps some front loading given that tariffs were expected. We had seen these announcements of more tariffs to come, so we could have seen some potential front loading of exports into the U.S. But the Kospi is now losing more than 1.7%, while the Korean won is holding steady. But Heidi, we're watching those global bonds as well, because it's really that risk-off sentiment, safe haven demand that's really moving the markets at this moment.
Yeah, you're taking a look at Australian 10-year break-even inflation rate, for example, falling to that 2-year low. There's so much uncertainty when it comes to this market. And actually, at the moment, we do have just some further data when it comes to the Melbourne Institute inflation numbers coming through. That was really an acceleration month-on-month, 0.7%, 2.8% for the month of March on a year-on-year basis. So really continuing to pull up from the previous reading of 2.2%. Inflation, that cost of living situation going to be front of mind for the RBA when they meet this week as well, but certainly front of mind for voters as they head into that election. But take a look at how we're sitting when it comes to the Aussie session. An hour into trade, we are seeing those broad declines to about 1.4%, I should say. This is the worst day since at least March 12th. That was the day that Australia failed to secure any exemptions when it comes to steel and aluminium tariffs. So you can kind of match the mood music there. Financials, materials, miners leading what is really a pretty broad decline, and you can see just the mentality of traders being on edge ahead of those April 2nd reciprocal tariff announcements there. The Aussie dollar also slipping a little bit at the moment. You're seeing that's a picture when it comes to treasuries. And I should mention we're watching, of course, oil very clearly, very carefully, I should say. A bit of a steadying, continuing to weigh this threat of more Russian penalties from President Trump. Well, amidst all this, let's bring in Kerry Craig, who's a global market strategist at JPMorgan Asset Management. Kerry, great to have you with us. And so, I suppose, in a sense, you can characterise the mood of this Monday session across Asia as being kind of a steady combination of all of the uncertainties and the volatilities that have been plaguing these markets for the past few weeks.
Absolutely. I think there's just a huge amount of unknowns when it comes to the outlook for tariffs. You've already seen a number of revisions to growth and inflation outlooks across the US from different brokers and banks. And I think it's just that reassessment of what this actually means, given that we've had a lot of these sort of anti-growth policies being enacted before more of the pro-growth policies that may come later in the year. And that's really denting both consumer investor confidence and weighing on the markets. And unfortunately, our expectation is that it's probably not going to be cleared up even with this week's announcements.
So where are you finding opportunity, or where are you finding, I guess, at least shelter from the storm, right? How do you approach all of the unknown unknowns as we see this market?
I mean, yeah, that's the big question. It's whether we are expecting to see this markets continue this downward slide or think about the potential for recovery. I think the answer to that is something that we all know, and that is to be diversified across asset classes, particularly within the equity space. So while we are looking at some downward revisions that have come in across the earnings outlook for the US, we've seen a big de-rating in stocks as well, and we're now looking for where we can find value in the market. It is again about that rotation towards global equities away from the US. So we are looking towards Europe a little bit more, given the fiscal room there is for expansion there, some of the rally we've seen in the defence space. We're also looking towards China, given we are seeing further announcements around support for the market there, and some of the enthusiasm around the AI story. And then within the US, we are still looking towards that market, given it is high quality, and the earnings outlook is still relatively robust at around about 10% for the coming year, but thinking more in terms of where we can find value across some of the more defensive parts of the market there. It would be a little bit of a risk to be underweight the US still in this environment. I think there's still a lot of good quality companies there, and as those valuations come down, you'll probably see more attractive opportunities outside those mega cap names.
Yeah, you're seeing the Nikkei now falling 3%. We're talking about the worst days in September of 2024. But it's not surprising. We're seeing that haven rally with global bonds continuing to gain ground. We're seeing really bond yields across the Asia-Pacific tracking what's happening in the treasury space as well. Treasury yields falling across the curve right now in cash trading. Is this the right call when there's so much uncertainty out there and we don't know where tariffs could go?
I think it is right. I mean, I wouldn't be scared of duration in the portfolio, given there are these sort of downside risks to growth. I mean, there's a rising risk of a recession. Those 1 in 7 year chance of recession is about a 15% probability. If we think about an average business cycle, we're probably running something that's closer to 20, maybe even 30% probability of recession in the US. So it does make sense to add a bit more duration to a portfolio, given that there are, now income that's been generated from those fixed income assets and that the yields could come down. We would be a little bit cautious about how far they would fall, given we don't have that base case of a recession, and there will be some concerns around whether that inflation is indeed transitory or becomes a little bit more sticky when it comes to the outlook for these tariffs they have on the outlook for inflation. So we may see those yields being a little bit more range bound than perhaps they would be if there was going to be an outright recession. So absolutely there could be further downside to yields on core government bonds in this environment, but we would be looking towards curve steepeners, thinking about just how far out you want to push on the duration curve just yet with some of those inflation concerns. But we would be looking to increase exposure to quality fixed income in portfolios, whether that's against the higher end of investment grade or thinking about a little bit more duration on core government bonds.
How difficult is the environment for central bankers across Asia? We do have the RBA decision that's not expected to be that shocking. We are expecting a hold, but given what's happening with the Australian economy, politics, we do have elections coming up, not to mention the Chinese economy and how dependent and reliable they are on China as well.
Yeah, I mean, there's a pretty much non-committal view from the RBA this week. I think they will be remiss to give anything away around the growth and inflation expectations, given they have just released their last set of projections at their last meeting. There probably hasn't been a huge amount of change from that. We had a monthly inflation number that was a little bit softer than expected. So again, may reinforce their view that you are seeing inflation that is going to be sustainably within the band, and again would lead them to be inclined to cut rates further over the course of this year, and that is our expectation. You'll see probably another 3 rate cuts from the RBA over the course of this year, given that policy is still restrictive. But again, that dynamic between growth and inflation will be weighing on them. I think central banks more broadly are going to err on the side of less growth and be willing to ease policy rates in this environment and look through a little bit more of higher inflation. And particularly will be focused on the labour market dynamics if we see any deterioration in the economy in terms of the labour market, whether it's the US or around the world or even Australia, being the deciding factor about how they think about the stickiness of inflation and whether the growth is really to the downside in this environment.
Kerry, when you look at China, do you look at it through the prism of it's a proxy for more sort of US geopolitical negativity, or do you see that potential diversifier, particularly if we see that tech and DeepSeek AI-driven rally continue?
I mean, there is a diversification angle here. If you look at the correlation between Chinese equities and the rest of the world, they do tend to move in a different direction. And we kind of lump it into the idea that you are seeing this constraint on the US economy because of these anti-growth policies. Obviously, they have a knock-on effect to what we're seeing in the rest of the world, but China, like Europe, has the potential to actually release more fiscal stimulus to support that growth coming through. And we expect that some of the policies we've seen so far will start to have more of a positive impact on the economy. And you have seen that in the economic data that's come out over the first part of this year. The valuations across the market are still relatively attractive, and we would sort of still look towards more of the soft tech space in China benefiting from some of this AI news to come through, and then looking more for domestic demand to pick up to really support the onshore market a little bit stronger. So I think there's a case for watching China very closely. The reciprocal tariff, they have a higher tariff relative to the US already, so the reciprocal tariff narrative may not be as impactful, and it'll be more targeted. And when it comes to the tariff and the trade policy between US and China, it does feel a little more transactional than sort of trying to gain another benefit such as market access. So we could see, just as we did back in 2018-19, China take steps to try and appease the US and buying up a certain amount of goods, which may ease some of those concerns around those geopolitical risks.
Kerry, Craig, good to have you with us. Global market strategist at JPMorgan Asset Management. As we continue to watch the Japanese markets, the yen continues to strengthen right now as we're seeing some safe haven moves against the U.S. dollar. But of course, we're watching those defense stocks very closely as we have the U.S. Defense Secretary Pete Hegseth in Tokyo. And we heard that the U.S. military has now begun upgrading its operations in Japan to a new warfighting command, really highlighting the Trump administration's focus on China. We have more ahead on the Asia Trade. This is Bloomberg.
President Trump says he doesn't think Russian President Vladimir Putin will go back on his word over US efforts to broker a ceasefire in Ukraine. Trump told reporters on Air Force One that he believes he's making progress on a deal ahead of a conversation with Putin this week. Let's bring up Bloomberg economy editor Michael Heath. And Mike, at the same time in this NBC conversation, he expressed his ire in pretty strong words.
Yeah, I mean, it was almost the first public criticism we've had of President Putin from Trump, and a degree of frustration and fairly reasonable one about some of the comments Putin had made on Friday when he said that President Zelensky, he repeated this idea that President Zelensky is illegitimate because Ukraine needs to hold an election, which it hasn't held because it's under martial law and constitutionally it can't hold, which is sort of a furphy. But for Trump, the main issue there was sort of the potential for this to then drag on the whole process of trying to get a peace deal there. Now I guess he's sort of reverting more to type, which is to sort of look on the more optimistic side. It almost reads almost as naivety, this notion that Putin wouldn't go back on his word. I mean, he whenever there is the opportunity to do something or greater advantage in doing it, Vladimir Putin has never had any hesitation in doing that. But it sort of speaks to President Trump's sense that he has this special bond or ties with Vladimir Putin. So far, so good in the sense that they've had this truce in various elements in terms of energy infrastructure, in terms of the Black Sea, but there's a lot of haggling going along there. Ukraine is still under attack in many ways, so the progress is really baby steps kind of thing. But we'll have to see what comes out of this conversation. I mean, whether Putin sort of hardens his stance on sanctions being lifted on the Russian bank that wants to rejoin SWIFT, and Trump having to try to coerce Europe for that. It's going to be a pretty significant conversation, that one.
And it's interesting because, of course, we've seen this kind of narrative that the US has been softening on Russia versus hardening on its stance when it comes to the UK and the EU. But we're hearing about maybe productive talks between the UK and the US.
Yeah, well, I mean, the UK's Prime Minister has made a real point of trying to revert to the UK's traditional role since World War II as a bridge between Europe and the US, which is a very sensible option, and it wants to sort of keep the US connected to Europe as best as it can. I mean, Europe needs US firepower, intelligence, or just that huge military complex that it has, and the UK at the same time sort of needs to try to negotiate a bit of a carve-out with the tariffs that are coming as well. So there's a few balls in the air, and so far the mood music seems to be fairly good coming from Prime Minister Starmer, and he said that from their conversation, the readout was that they sort of agreed that more pressure needs to be exerted on Russia in terms of sanctions and this sort of thing. I mean, President Trump also said that he doesn't intend to impose any sort of secondary sanctions on Russia at this stage, but keeping the option alive. I mean, that would be a significant move. That means sort of try to suppress the trade with India and China, which has really kept Russia's economy afloat. So he does have a bit of a stick to will there, if it can be implemented. We'll just have to wait and see on that one.
Mike, what's happening with Iran? Because President Trump continues to talk about these secondary tariffs on Iran, but would that even make a difference for a country like Iran?
Yeah, look, Shery, it's difficult to tell. I mean, because there's the talks and the negotiations are sort of, they're being done in letter and then just bibs and bobs that are sort of coming out. But President Trump has sent a letter to Iran, to the head of Iran, to the supreme leader there, and who apparently has responded as well. But yes, the whole shadow fleet and the oil exports that take place, sort of avoiding sanctions. The idea, I guess, is that you would penalise the recipients of that oil. They get it sort of cheaper. They get very good deals on that in order to keep the trade going. But yeah, look, it is questionable, and he seems to be trying to do the similar sort of thing with Venezuela as well. So, I mean, we're in sort of new territory here, so we'd really have to just sort of see, Shery, how it plays out. But some countries really would probably prefer to avoid the wrath of the US, and it might just be easier going to the normal oil market, and perhaps it does tighten the screws on a country like Iran.
Bloomberg economy editor Michael Heath there. Let's take a look at how European futures are opening up for the Monday session, given all of the risk aversion that we're seeing so far in Asia, but a bit of a recovery when it comes to US futures. We have seen, of course, the pan-European stock 600 outpacing the S&P 500 by nearly 17 percentage points this quarter in dollar terms. That is a record outperformance. You're seeing a bit of downside there, and the question, I suppose, going forward is how long these inflows really can be sustained, given that we've seen all the positivity over Germany's fiscal plans, lifting the kind of broader mood around the European outlook amidst earnings as well as sort of economic data as well. But Goldman Sachs, for one, seeing that it's unlikely that the inflows of international capital into European equities that we've seen so far will continue to stay as strong as they currently are. They say they're sceptical. This marks a wholesale return to persistent buying or large reallocation to Europe. So a little bit to the downside there when it comes to that view.
And we're headed towards the Chinese market opens as well. Chinese stocks have surged in the past 6 months or so. We're now hearing from the finance ministry. We're expecting them to inject $69 billion into the country's biggest banks through share placements, following through on Beijing's earlier pledge to beef up capital buffers. Our chief North Asia correspondent Stephen Engel joins us now from Shanghai. Steve, so why was this needed in the first place?
Yeah, I mean, it is a good question because actually the big state banks' capital levels are above the requirements. But again, they've been kind of tasked over the last several years to support the real economy as the property sector has been hurt. Obviously, there's some rise of non-performing loans, and there's just been some shock. So net interest margins at the Chinese banking industry sank last year to 1.52%, the lowest ever. So they have profitability issues. They have this record low margins and, of course, rising bad loans. So we got a signal from authorities back in September that they would likely recapitalize the banks. And now we got that as well as part of the marching orders from the National People's Congress. And now we have the first step, 4 banks to start off, according to the Ministry of Finance. We're talking about Bank of Communications, Bank of China, Postal Savings Bank of China, as well as China Construction Bank, plan to raise up to a combined 520 billion yuan through additional domestically listed stocks. Ministry of Finance, after this is done, will be the top investor in all of the proposed private placements. And the banks will issue the new shares at a premium between 8.8% and 21.5% above their Friday closing levels in Shanghai. So again, you know, the recapitalizing of the banks will help service the real economy. And that's what they're trying to do, is they try to boost domestic consumption against the backdrop, of course, of the Trump trade war.
Steve, at the same time, Xi Jinping's business leader charm offensive continues, this time on a sort of a global scale. What do we know about that meeting in Beijing?
Yeah, I mean, it is a charm offensive, and that was a term that was used repeatedly when I was at the China Development Forum last weekend, as well as throughout last week at the Boao Forum. And we knew that this was going to likely happen. It did on Friday here at the Great Hall of the People in central Beijing. Xi Jinping meeting about 40 heads of multinational companies. We're talking Steve Schwarzman of Blackstone, Judy Marks of Otis, Raj Subramaniam of FedEx, Cristiano Aman of Qualcomm, Ray Dalio of Bridgewater, Albert Bourla of Pfizer, there's Dalio there, also J.Y. Lee of Samsung, Akio Toyota, Pascal Soriot of AstraZeneca. Long list of people who have had a long history, and companies that have had a long history of investing in China. And that's something that Xi Jinping appealed to. He says, we are providing transparent, steady, and predictable policy environment. He called China a favorite destination of foreign investors, and, quote, embracing China is embracing opportunity. So obviously, Xi Jinping, following that meeting in February and kind of bringing back those private enterprises like Alibaba, domestic private enterprises, back in from the cold, and now reaching out to foreign business leaders. It is part of a charm offensive to kind of boost foreign direct investment, for one, into China, because we saw FDI in China dropped by the most in more than 3 decades in 2024. Xi Jinping, against the backdrop of the trade tensions from the United States, would like to reverse that.
Our Chief North Asia correspondent Stephen Engel there in Shanghai. More ahead on the Asia trade. This is Bloomberg. Some of the other stories that we're following this hour, President Masoud Pezeshkian says that Iran has told President Trump that it won't engage in direct talks with the US. In televised remarks, he said Iran's supreme leader has responded to Trump's letter earlier this month on possible talks over its nuclear program. Even so, indirect communication with the US is still possible. Israeli Prime Minister Benjamin Netanyahu's office says it sent a counter-offer to mediators after reports that Hamas had agreed to a proposal for a new Gaza truce. Israeli media say Hamas agreed to release 5 living hostages in exchange for a 50-day ceasefire. Israeli forces have started ground operations in Rafah and southern Gaza while continuing airstrikes throughout the Strip. Take a look at what we're seeing when it comes to oil at the moment. We're seeing sort of a steadying in trading, investors reacting, but now just sort of watching for further details when it comes to President Trump's threat of new penalties on the flow of Russian crude if a ceasefire with Ukraine is not reached. Trump had said he would impose these penalties if a deal on Ukraine isn't reached, and that he thinks that is Russia's fault, but then later came back and said that he's not implementing any further oil sanctions at present. We are seeing on a monthly basis, though, oil futures on track for that advance, but the sort of broader outlook globally remains pretty bearish for the rest of the year, given that we are expecting rising supply and OPEC Plus, Shery, set to revive idle production next month.
Yeah, no wonder we've seen that range-bound trading when it comes to oil prices for the past few months, about $15 between the highs of 60s and lows of 80s or so. But take a look at that risk-off sentiment now being felt across Asia as well, with the Nikkei now losing more than 3.5%. We're talking about the worst day since September of last year. We had some data coming out of Japan as well, industrial output rising 2.5% month on month. That beat expectations. We also have retail sales numbers, but it's really about the broader risk-off sentiment right now across the world. That we're seeing global bonds also continuing to rally. The Japanese yen right now at that 149 level against the US dollar, strengthening as we have seen in the past couple of days as well. Perhaps also a function a little bit of the US dollar not necessarily reacting as a safe haven during market sell-off this week, instead sinking against other currencies we've seen, given, of course, the tariff threats and perhaps some of those discussions about whether overseas governments could be accelerating efforts to lessen the reliance on the dollar, Haidi.
And Shery, you just mentioned the global outperformance when it comes to bonds, and you're seeing that supporting gains in JGBs amongst regional sovereigns as well as Aussie bonds and bunds as well. But we're seeing Treasury futures just soaring on Monday, all of that supporting the regional players. Well, clearly Treasuries are the standout play as this trade war intensifies. We're seeing investors really shifting allocation in favour of bonds over global equities. That outperformance between Treasuries, 2% gain, the S&P about 5% down this quarter.
Take a look at live pictures right now of that collapsed building in Bangkok. This, of course, after the powerful earthquake that rocked Myanmar and neighboring Thailand on Friday. We have seen those safety concerns continue across Thailand. Safety concerns already affecting tourist arrivals in Thailand as well. We have seen this impact on tourism hurting Thailand's economy, which of course relies heavily on the industry. Some forecasts saying that Thailand's growth forecast of 3% this year could actually be affected as you're watching that collapsed building in Bangkok. In Myanmar, rescuers still working frantically to find survivors 3 days after that powerful earthquake, the biggest in a century. The military government now saying that around 1,700 people were killed in Friday's massive quake centered near Mandalay, with more than double that number injured. Let's bring in Bloomberg editor Margot Towie, who joins us now from Bangkok. Margot, what do we know at this point?
Well, pretty much what you have just outlined. That's where we are at the moment. The impact in Thailand was fairly limited. Really, the biggest thing was the collapsed building that was under construction and the loss of life there. The big deal is obviously Myanmar, which is difficult to access due to infrastructure constraints, a country that's having a civil war at the moment. Definitely tourist arrivals will be affected. I had to walk home on Friday as there was no public transport and the streets were completely gridlocked and the streets were just lined with people, so many people with suitcases sitting outside of buildings, nowhere to go. So that will be the immediate impact, and we'll probably see a hit on some of the related stocks when the stock market reopens today. It was closed after the earthquake.
There is, of course, at least a ceasefire. Is that expected to help progress some of the aid that's coming in, and how much support are we seeing from international aid providers?
Well, a ceasefire will have a limited effect simply because the infrastructure in Myanmar is so poor. After years of war, there's been a lot of damage and it's very difficult to get from point A to point B or C or D, with the earthquake exacerbating that even further. If you look at the fault line, it literally runs straight down the middle of Myanmar, so it pretty much cuts the country in half.
Bloomberg editor Margot Towie there with the latest. Let's take a look at how we're tracking these markets on this Monday morning, mid-session sort of here in Australia, and we are seeing sort of the first half an hour of, look, some pretty risk-averse trade there across the rest of the region. This, of course, as we are sort of playing countdown to that April 2nd announcement of reciprocal tariffs expected from President Trump. We're seeing further geopolitical concerns when it comes to global oil supply, with Trump threatening further sanctions or more sanctions when it comes to the flows of Russia oil. Although he has clarified that that hasn't happened yet, we are seeing oil kind of starting to moderate some of that earlier fall that we've seen. We've seen Japanese stocks, so take a look at how steep that decline is, 3.7% lower, just really slumping and adding to last week's losses. It's putting the topics, at least, in negative territory for the first quarter. Japan looking to face auto tariffs along with other nations, and we're seeing that slide being reflected when it comes to Australia and Korean stocks as well. Well, South Korea's 17-month ban on short selling expires today. That is expected to boost overall liquidity. It should also help the country's bid to be upgraded to developed status from emerging in the MSCI's equity gauges. For more, let's bring Bloomberg Asia Stocks report to Sang-Wee Cha. And Sang-Wee, on a day like today, it's really hard to kind of talk about any upside catalysts for equities at the moment. But tell us about the resumption that we're seeing here.
Yeah, so we saw the benchmark Kospi open as lower as much as 2.3% this morning. This was pretty much expected in the market. A lot of the market watchers were saying that there will be a short-term volatility and a lot of that negativity when the short selling ban resumes, and that's of course because it was put in place in November of 2023. A lot of the hedge funds and global investors were just waiting to place that long-short strategy on the Korean stocks. And so this is somewhat expected. And so we're seeing that, but it's more to do with the tariff woes that's upcoming after Trump's remarks. And a lot of that is because Korean market is more dependent on that export-driven trades. And so that immediately affects the automakers in Korea, and because of that auto tariff that we have seen, and many more concerns that is just looming. And also it just comes at a time when Korea is going through the political turmoil from that martial law decree that was imposed in December of last year. And so we are still yet to decide. The country is waiting to whether the regulators, whether the Constitutional Court is going to be really stripping off the president from his impeachment, his presidency, or in fact reinstate him back to his term. So all of this just comes at the same time, and so coincidentally, we're seeing the benchmark a bit. We're seeing that a sea of red today, and so we'll be looking at that.
And yet Heidi mentioned the potential inclusion or upgrade when it comes to Korean equities in global indices. So what could be the long-term benefits here?
Yes, so what happens today is that around 2,800 listed companies are going to be available for short selling for global investors. And that short selling itself, the practice is just healthy for the market. And so that is going to increase the possibility for the Korean stocks to be added and to be added to that watch list for developed for the DM status in MSCI. That's what the Korean market and the Korea itself has been wanting for a long time from an upgrade from its EM status. And so we are going to be seeing whether this will happen. This usually happens around June this year, or maybe it could come next year as well. And that will be very key for the Korean markets. But we'll have to watch as the global investors have been kind of sitting out the rally, offloading about $20 billion worth of Korean stocks since August. So we'll have to watch what happens with the tariffs and throughout the day today.
Former Sang-mi Cha there, joining us with the latest on Korean markets. But one company that we're watching in South Korea, AI startup Wrtn Technologies, saying that it secured additional financing of $74 million to close a Series B funding round led by U.S.-based Goodwater Capital, the company's chat software servicing Japanese and non-English speaking markets. And it's now partnered with Microsoft South Korea. Joining us exclusively now is the founder and CEO of Wrtn Technologies, Hae-young Lee. Hae-young, good to talk to you again. So congratulations on this latest funding round. What do you expect to do now?
Yeah, thank you for having me back. And we will use it to grow our traction even faster than we did in the past, and focus more on the Japanese market. And I'd like to share our growth strategy. And we are focusing on two key areas. First, Wrtn is moving closer to daily AI rather than a productivity or work-related AI. When we first saw GPT models, our initial reaction was that, oh, this could be a natural language interface for all the people out there. And of course, as you can see with ChatGPT, our initial use case was largely personal productivity. But we quickly expanded our product to character and companionship. So we will continue to go deeper into these kinds of daily use cases beyond productivity as we move forward. And second, we are personalizing every single interaction. You customize your smartphone, laptop, and even human relationship, right? And what I want to say is, why should AI be the same for everyone? Don't you want to have AI that is tailor-made just for you? This is what we are doing with our products, and the AI system will understand you as you interact with it and act as a personalized software of yours.
You said that you wanted to focus on the Japanese market. Why is that, and how much progress have you made so far?
Yeah, so we really focus on Korea and Japanese. This is the non-English market, and we reached over 0.5 million MAU in Japan market right now.
Does that mean that you could also expand to other languages as well?
Pardon?
Does that mean that you could be expanding to other languages as well if it's non-English speaking? And when could that timeline come?
This year we're gonna launch a character chat platform in Japan market, and then next year we're gonna go Southeast Asian market.
Where specifically in Southeast Asia do you see the most business opportunity?
So we are looking for Singapore and Thailand and Indonesia market for character chat and companionship products.
If you take a look at some of the sort of ecosystems within these markets, where do you see it as being most favorable for a startup like yours?
Yeah, so we're gonna do like a Southeast market for same as Korea strategy. So the first one is daily AI, and then second one is companionship.
Where do you see the most sort of commercial opportunity when it comes to the application of your product?
Yeah, our only pricing is in the character chat now, and where you can buy super chat or more engaging character chat. So I think it's a very big chance in the entertainment domain and personal companion domains. And
when you talk about companionship, does that affect that?
Yeah.
When you talk about companionship, does that affect what sort of ages, what sort of demographics you're targeting?
So pretty young people are using Wrtn especially. So 10 to 20s. Our new joiner is 70% of 10 to 20 users. The average is 27.
So, Lee, really great to have you with us, founder and CEO of Wrtn Technologies. More ahead on the Asia trade. This is Bloomberg.
Defense Secretary Pete Hegseth says that the U.S. military has begun to upgrade its operations in Japan into a new war-fighting command. The move highlights the Trump administration's focus on China as its primary security challenge. That's bringing Tokyo Bureau Chief Isabel Reynolds. And Isabel, we've heard from President Trump before really criticizing the Japan-U.S. alliance. So what could we actually see during the actual visit of his defense secretary?
Yes, well, as you say, in the run-up to this visit, there was a lot for Japan to be concerned about. We saw one of Trump's nominees for the Pentagon in an important position there, calling for Japan to raise its defense spending to 3% of GDP, as opposed to the current sort of about 1.5 on its way to 2%. There was Donald Trump himself coming out saying this, well, this is a very interesting alliance where we have to promise to defend Japan. Japan doesn't have to do the same for us, which was something that caused concern in Japan, of course. And then, of course, there was looking at the whole European situation and seeing the US going over to Europe and saying, calling into question really the whole alliance between Japan, between the US and Europe. So there was obviously some concern in Japan, are we going to be in the same boat here? In the end, none of these concerns really materialized into anything big this time. And Pete Hegseth really came with a message that was a continuation of what we saw under the Biden administration. That the alliance was very important, that they would continue to strengthen it. What you've been talking about in terms of war fighting stance, that was something that was very much under the Biden administration. So you can almost hear the sighs of relief in Japan here now. Of course, the fact that these issues were not raised this time doesn't mean that they never will be. But for the moment, everything is sort of peace and calm on this side of the ocean.
It does reflect the fact that obviously the Trump administration and in the US generally sees China as the kind of prime security concern, right? Have we had a response from Beijing?
I don't think we've heard a direct response so far, but I think we've seen some very interesting moves on the Chinese side. I mean, it's almost rather contradictory. We're seeing, in military terms, we're seeing more pressure on US allies in the region, I think. We're seeing, for example, more incursions into islands around Japan than we have seen in the past. There was a record length of stay and incursion into islands in the East China Sea, for example, just the other day. But at the same time, China seems to be trying to portray itself as a reliable trade partner. So we've seen these three-way talks with South Korea and Japan at the weekend. And in that environment, China was very much trying to say, well, look at us. We are the people, we are the country that is wanting to pursue free trade and these values that in the past, perhaps Japan would have looked to the US to supply. Now we're going to be the ones who will supply that for you.
And that's the thing, right? I mean, the fact that, as you said earlier, just because President Trump is busy right now with so many other things around the world, it doesn't mean that it will eventually turn his focus to Japan, right? In the past, when we look at Japan-U.S. relations, what were some of the major sticking points that could come up later?
Right. Well, I think Donald Trump has raised one of the major ones, that it's the fact that we have this unequal alliance where Japan doesn't have to defend the U.S., obviously. There were a lot of reasons for having that alliance in that particular form. Obviously, Japan has a pacifist constitution. There's a great limit on what it can do. And in terms of public opinion, whether the public would be behind any military action outside the immediate vicinity of Japan is very difficult to sort of ascertain at this point. I mean, I think stances towards defence are changing in Japan, but that would be a very drastic step. Then there's the issue of spending, of course. The US has raised the issue in the past during the first Trump administration of having Japan pay a lot more to have the US troops stationed in Japan. That doesn't seem to have arisen on this occasion, but it doesn't mean that it never will, of course.
Isabel Reynolds, our Tokyo bureau chief, with potentially more news to come on this front as well. More ahead on the Asia trade. This is Bloomberg. Take a look at how Japanese assets are trading at the moment. We're seeing a broad sell-off, risk-off sentiment with the Nikkei now losing more than 3.5%. We're talking about the worst day since September of last year, while JGB yields also are continuing to follow global yields lower. We are seeing that bond rally globally on that risk-off sentiment with economic uncertainty, with tariffs also to be announced, the Japanese yen continuing to strengthen. Bloomberg senior Asia stock reporter Hideyuki Sano joins me right now. And Hide, we were saying that, okay, we knew that there was going to be a market impact. We knew that about the tariff uncertainty. The Japanese yen is stronger. But this level of losses in the Japanese equity markets, why are we seeing such a big reaction?
Good morning, Heidi. Shery. I mean, it's basically all about tariffs. But I also need to point out that this is the final day of Japanese fiscal year, so a lot of Japanese institutional investors are reluctant to take any positions. So on a normal day, they might have been eager to buy at these levels, but this is the day they just don't want to do this. But of course, concerns about tariffs are growing, and people are also talking about the real impact of tariffs on the U.S. economy. We have seen signs that U.S. consumers are getting more pessimistic about their economic outlook. So I think it's a combination of these things leading to massive losses this morning. And I would assume that after the turn of the year, this fiscal year factor will disappear. But at least for today, I don't think there'll be meaningful buying in the market.
Especially also given that the Japanese yen has been stronger for a few days already. We're past that 150 level against the dollar.
Yeah. I mean, in the grand scheme of things, the yen levels around 150 wouldn't be a big deal, but given the nervousness in the market, I think every incremental increase in the value of the yen would be negative, because there are players who sort of do this sort of correlation trade. That said, I would assume unless the yen keeps rising towards 140, that wouldn't be a severe blow to the Japanese stock prices at this point.
Hedo, what's the broader outlook then, and how much longevity do we see in these tariff concerns?
Yeah, that's a very tough question at this point, because a lot depends on the type of tariffs the U.S. administration is going to introduce. I think, based on what I've been hearing, some people think that there's a good chance the market will rebound at this point, because the valuation at least has become very cheap, or at least reasonable. On the other hand, some analysts are starting to revise down the earnings outlook of Japanese companies, just because they now need to consider the impact of tariffs. So there will be tug of war between those two factors, and it's highly uncertain at this point.
Our senior Asia stock reporter Hideyuki Sano there. Joining me here in the Tokyo studios, we continue to watch the broad sell-off that we're seeing across Asian assets. We're also watching Korean EV battery stocks tumbling at the moment. Of course, we have seen South Korea now opening lower broadly, not only because of global risk-off, but also their months-long short-selling ban has lifted today. So authorities have removed that 17-month-long ban on short selling. We were expecting some near-term volatility, and you can see on a day like today, we're seeing big effects across the board, especially when it comes to those EV manufacturers, Heidi.
Shery, take a look at what else we're watching on the corporate front. And Elon Musk says his AI startup XAI has acquired his X social media platform at a valuation of $33 billion. The all-stock transaction streamlines Musk's businesses and solidifies the relationship between XAI and X after the startup used X data to hone its chatbot, Grok. Sources tell Bloomberg that the deal gives a new combined entity called XAI Holdings a value of more than $100 billion, not including debt. Chinese property giant Country Garden has posted a narrower loss for 2024 after a series of steep write-offs on properties both finished and under development. The loss for the year came in at about $4.5 billion compared with a record $24 billion in 2023. Country Garden is still in restructuring talks more than a year after defaulting on its debt. China's Hong Kong and Macau Affairs Office has reposted an editorial from a local pro-Beijing newspaper urging CK Hutchison to stop a planned deal to sell its 2 Panama ports. The report says the consequences will be serious otherwise. Bloomberg reported last week that China has told state-owned firms to hold off on any new collaboration with businesses linked to its founder, Li Ka-shing, and his family. Take a look at how US futures are tracking at the moment. We are broadly risk-off as this stock slump deepens. We're looking at the topics in particular trouble at the moment. This is Bloomberg.